Yes. So let us start with the unit 2. Okay. To begin with, let us understand what is cost of capital. Okay. So cost of capital can be defined from both, from the organization's point of view as well as from the investor's point of view. From the organization's point of view, cost of capital is a rate at which an organization raises capital to invest in various projects. So to invest in various projects, basically, that is the main purpose why an organization will raise capital, isn't it? So the cost which they have to pay in order to raise that capital is nothing but cost of capital. Now if they take a loan, in that case they have to pay interest. If they issue shares, in that case they have to pay dividend. So dividend, interest, this is nothing but the cost of capital. Okay, the basic motive of any organization to any kind of capital is to invest in its various projects for earning profit. Further, out of that profit, the organization pays the interest and the dividend. The amount paid as interest or dividend is considered as cost to the company for raising the capital, that is cost of capital. Now, whatever purpose for which the organization has raised the capital, the company should utilize that capital. They cannot keep that capital idle. You cannot take a loan and keep the money in your house. You have to do something with that borrowed amount. Either you build a house or you buy a car or what it is up to you. But you need to do something with that money. If you don't utilize that money at the end of the term, for whatever term that you have borrowed the amount, you will have to pay a certain amount of charge in form of interest. So that is the reason why a company or an individual cannot just borrow loan from the bank and keep that money idle in their house. They have to utilize that amount in order to profit out of it in some or the other way. Because from that profit only, whatever the company will make by utilizing that fund, the company will have to pay the interest from that profit only to the bank or to the general investors, that is the general public at large. If they have issued the shares, then to the general public at large, they will have to pay the dividend out of those profits only. In case they have borrowed from the bank, they will have to pay the interest to the bank from those profits only. Otherwise, it is a loss to the company. Okay, so that is the basic motive. Whereas from the investor's point of view, cost of capital is the rate of return which the investors expect from the capital invested by them in the organization. Now, if a person, an individual investor is basically investing in your company, it means that the investor has some expectations from your company. If I am investing in Reliance Industries, I have certain expectations from the Reliance Industries. That is the reason why I am investing my hard-earned money in Reliance Industries. If any individual investor is investing in any company or any venture, basically they should have some expectations. Then only you will invest, right? Now, your family and friends, they can give you the money. They may not have any expectations that you will pay them 10% interest at the end. But if you take money from the bank, say for the purpose of building a restaurant, the bank will have certain expectations, right? That you are going to pay some amount of interest to the bank at the end of the term of your loan. Similarly, with respect to company, when an investor is investing in a company, basically the investor has certain expectations from the company, that the company will give me so much returns, the company is going to give me so much profit. This is what the expectations of the investor are. So whatever the expectations of the investor are is nothing but the cost of capital. Whatever the investor is expecting that the company will pay in return for the funds which the investor has given to the company is nothing but cost of capital. If I am investing in Reliance Industries, I am expecting that they should pay me at least 10% of dividend every year. Let us say I am expecting. They pay only 7% or 8%. But when they are paying that 7 or 8%, they have to take into consideration how much I am expecting also. Depending upon the profits they will pay. This year they will pay 9%, next year they may pay 12%. My expectations are 10%. So it can be above my expectations or it can be below my expectations. But basically whatever my expectations are, that much they have to pay. So it is a cost of capital. My expectations are the cost of capital for the company. Okay. So that is cost of capital meaning. Cost of capital refers to a discount rate that is used in determining the present value of estimated future cash flow proceeds of business or new project and eventually deciding whether the business project is worth undertaking or not. So if I want to invest in Reliance Industries, I am going to have some expectations. Now, in order to understand what my expectations are in terms of amount, I will have to determine the present value of the expected future cash proceeds that I am considering that Reliance will pay for me. Now, if I'm I'm analyzing, let us say, I'm saying that if I invest 10,000 rupees in Reliance Industries today, how much will I get in future? Right? Let us say I am assuming that I will get 1 lakh in future. Then in that case, what is the present value of those future cash proceeds? Basically, that is nothing but cost of capital. You have to discount, it is a discount rate which is basically used to understand the present value of your future cash proceeds which you are going to get in the future. Okay, it is the minimum rate of return that a firm must earn on its investment. That is the minimum rate of return that the firm must earn. That much of returns the firm must earn if they want to keep their investors happy, which will maintain the market value of the share in its current level. Okay, so that is the cost of capital. Now, in case of a new company, the sources of finance are as follows. If it is a new company, then it can raise funds through equity, through preference share, through debt. If it is an old company, that is existing company, in that case, equity, preference, debt is there only, but there will be something called as reserves and surplus. Reserves and surplus are nothing but the excess amount of profits which the company has earned over a period of time. Some amount from that profit is kept aside for the purpose of issuing dividend maybe, or for some contingencies maybe, but it is kept aside. That is reserves and surplus. That is also a source of finance for the company. Even the reserves and surplus are a source of finance for the company. They can use the reserves and surplus, they can invest it back into the company, they can expand, they can do anything with their reserves and surplus. It is a source of finance for the company. Okay. So these are the different sources of finance in case of existing or an old company. Then now let us move on to the weighted average cost of capital. What is this weighted average cost of capital? This is what is the question over here. If a company uses more than one source of investment purpose, then you are required to find the weighted average cost of capital. Now obviously a company won't have 100% equity, 100% debt, 100% preference shares. They are not going to raise capital like that. It is going to be a combination of different sources. It is going to be 50% equity, 20% debt, 20% loan. That way they are going to divide it among different sources. You cannot put all your eggs in one basket, right? If the basket falls, all the eggs will break. That is the reason why the company will invest in different sources of finance. Okay, the same principle is applied over here. So in order to understand the weighted average cost of capital, we will have to take into consideration all the sources and the weights of all those sources of finance. Okay. So for calculating the weighted average cost of capital, we need information on the cost of various sources of capital and the proportions of weight applicable to them. Now, in order to find out the weighted average cost of capital, obviously we will need the cost of capital. This KE, which you can see, it is the cost of equity. KP, which you can see, it is the cost of preference. And KD, which you can see, it is the cost of debt. We need all three, that is KE, KP and KD. We need the cost. And that cost needs to be multiplied with the weight. Now, this is weight of equity, weight of preference, weight of debt. Now, what is weight? As I told you, in an organization, no, like a organization is not going to invest 100% equity shares, 100% preference shares, 100% debentures. It is going to be this way: 50% equity, 25% preference, 25% loan. So that 25%, that 50%, that basically those percentages, that percent of investment which is made in equity, that is, I told you 50% of the funds are raised from equity, 25% are raised from preference shares, 25% are raised from loans. So in that case, that 25%, that 50% is nothing but the weight that you need to take into consideration. Okay, so we are multiplying the cost of equity with the weight of equity, cost of preference share with the weight of preference share, cost of debt with the weight of debt, and that way we will get weighted average cost of capital. Okay, so in order to calculate the weighted average cost of capital, what we need two things. First is cost of capital, and the second thing is proportions of weight applicable to them. Okay, so that is the most important thing that you need to take into consideration. Okay, so by adding all these individuals, that is weight of equity multiplied by cost of equity plus weight of preference multiplied by cost of preference plus weight of debt multiplied by cost of debt, you will get something called as weighted average cost of capital. That is the cost of capital of the entire company based on the different sources of finance. Okay, so now let us move on to the problems based on this. So now let us move on to the cost of capital problems. I'll read out the problems for you all. The first one, that is, a company has 10% redeemable preference share which are redeemable at the end of 10 years. So we know that there are preference shares. So we can write down the details. Preference shares, interest 10%. Okay, and redeemable preference shares which are redeemable at the end of 10th year. Okay, the underwriting expenses are expected to be 2%. So expenses, underwriting expenses are expected to be 2%. Okay, find out the effective cost of preference share capital. So they are saying find out KP, that is the effective cost of preference shares. So now let us find out based on what is given to us. Okay, so now in this problem you all must have noticed that they have not mentioned us the face value. Whenever the face value is not mentioned, we should assume the face value to be 100 rupees. So let us assume that the face value is 100. I repeat again, whenever the face value is not given to us, we should assume that the face value is 100 rupees. Okay, now we can calculate the interest. We can calculate the interest directly on the face value. Okay, then we know the number of years, which is 10 years. Obviously the redemption value we will know, that is going to be the face value only, and we need to find out the present value. Now you all must have mentioned that they have given us the expenses. Okay, now these expenses, the underwriting expenses, we will have to deduct it obviously from the face value in order to understand what is the current value. Because underwriting expenses are incurred basically when you are going to issue those preference shares in the market. When you issue it initially, when you issue the shares, you have to pay the underwriting expenses, isn't it? So that is the reason why what we will do now currently is, in order to understand the current price, we will deduct that underwriting expenses from the face value. Now the formula will remain the same. Let us write down the formula. It is going to be the dividend plus redemption value minus the present, let me write it as future value minus the present value divided by n, future value plus present value divided by 2. Okay, so dividend we know, you take the face value which is 100, multiply it with the interest rate which is 10%. Okay, so 100 into 10% plus, now we know that the face value is rupees 100. Now, since the face value is rupees 100, it is not given to us what kind of a share, what kind of share it is, whether it is going to be redeemed at premium, whether it is going to be redeemed at discount, nothing else is mentioned over here. That is the reason why we consider the face value as the redemption value, because we consider that it is issued at par. Now coming on to the present value, in order to calculate the present value, what we will have to do? In order to calculate the present value, we will have to take the face value which is 100 rupees minus the flotation or the underwriting expenses cost. Flotation cost or underwriting expenses cost is nothing but the cost which you incur in order to issue or launch your shares or your security into market. In order to launch your security in the market, you need to pay some cost. It can be to the underwriter, it can be some fee to the stock exchange, whatever it is, that cost you need to deduct it from the face value in order to understand the current value. Presently, what is the value of your security? So 100 minus 2%, how much it comes to? It comes to 98. Okay. So we know the redemption value, the future value or the redemption value, we know that it is 100 rupees minus the present value, the current value or the sales value we know currently at what rate it will be selling. Obviously it will be selling minus the expenses, right? The company has to recover the expenses from the face value itself, isn't it? So 100 minus 98, the whole divided by, we know that n is equal to 10 years, right? I told you that it is redeemable after 10 years, so divided by 10. Then 100 plus 98, the whole divided by 2. Now let us solve this equation. You will get over here 10 plus 90.2, the whole divided by 99, which is nothing but you will get the answer as 1.0121. 1.0121. Okay. So I hope it is very clear to you all now how we are getting this. First and foremost point to be noted, what I told you all is that the face value, if it is not given to us, basically what we have to do is we have to consider it as 100, because we need to calculate the interest. Everything is dependent on the face value. Then whatever the expenses whichever are given, be it flotation cost, be it underwriting expenses, we will have to deduct it from the face value, which is nothing but rupees 100 in this case. We will have to deduct it in order to understand the current price, that is the present value or the current selling value of your securities in the market. Once you deduct it, you will get the present value. You know the number of years, you know the interest rate, you know everything. You can substitute the values in the formula and you can find the value of KP, that is cost of preference shares. I hope this first problem is very clear to you all. Now let us move on to the second problem. I will read it out to you all. The entire share capital of a company consists of 1 lakh equity share of rupees 100 each. So they have said that there is a share capital worth rupees 1 lakh equity shares of rupees 100 each. The current earnings will be obviously 1 lakh into rupees 100. It is going to be 10 lakhs per annum. The company wants to raise additional funds of 25 lakhs by issuing new shares. The flotation cost is expected to be 10% of the face value. They have asked us to find out the cost of equity capital given that the earnings are expected to remain same for coming years. So now let us write down what is given to us. Firstly, I'll jot this down, then we can write down what is given to us. Yes. So they have given, now in this case, they have given us the face value, which is rupees 100 each. So let us write down that at least. So the face value is rupees 100 each. Okay. Then they have also given us the flotation cost. Flotation cost is equal to 10%. They have specified the flotation cost. And they have asked us to find out the cost of equity capital, that is KE. Now they have also given us number of equity shares, which is 1 lakh. They have also given us the earnings, which is nothing but 10 lakh. Okay. They have given us all this information and they have asked us to find out the cost of equity. Now, if you all know that the price earning approach model of equity, if you all know that, if you all remember that, I'll write down the formula here. Price earning approach. If you all know this, you all know KE is equal to, according to this approach, KE is equal to EPS divided by market price per share. Now earnings per share we can calculate, EPS we can calculate. How will you calculate EPS? EPS is nothing but the earnings divided by number of shares. If you want to know the earnings per share, that is EPS is nothing but earnings per share. If you want to know the earnings per share, obviously you take the total earnings and divide it by number of equity shares. That way you will get the earning per share. To understand it, in order to understand the earnings per share, you take the total earnings and divide it with the number of equity shares. You will get the earnings per share. Okay, so EPS is equal to earnings divided by number of equity shares, which is nothing but 10 lakh divided by 1 lakh. 3, 3, 2, 2. So it comes to 10 rupees. So EPS is 10. Market price per share, you know, I told you, the current face value, whatever it is, minus the flotation cost will be the current value or the present market value. So let us calculate that present market value. So present market value is equal to face value minus flotation cost. Okay, so face value is what over here? 100 minus flotation cost is how much? I told you it is 10%. So it is going to come to 90. So we know the current present market value, we know the EPS. Let us substitute and find out the value of KE. So KE is equal to EPS divided by market price per share. EPS, you know, it is 10 rupees. Market price per share, you know, it is 90 rupees. So 10 into 90, it comes to around 0.11, which is nothing but 11%. So I hope this problem is also clear with you all. Very simple it is. You just need to remember the different approaches which are there under equity. Once you read the problem, just jot down whatever is given in the problem. Once you jot down whatever is given in the problem, try to recall the different models under which you can find out the value of equity. Once you recall all the different types of models, you yourself will identify which model you have to use. Now in this case, if G was given, that is if growth was given, it would become price earning growth model. But over here growth is not mentioned. That is the reason why we use the simple price earning approach.
But if G was mentioned, that is growth was mentioned, then we would have to use price earning growth model. Okay, so based on whatever the particulars are given to you all will have to go through and recall the different types of models which are available and try to select the suitable model which you all feel will help you all to find out KE. Okay, I hope that is clear. Now let us move on to the next problem. Now let us move on to the next problem. Okay, in the next problem we are going to find out the weighted average cost of capital. In this problem they have given us the different sources of finance which are available to the company. First one is equity, then is reserves, and then is debt. Then they have also given us the book values of that respective source of finance. For equity it is 2 lakhs, for reserves it is 1,30,000, for debt it is 1,70,000. And they have asked us basically to find out the weighted average cost of capital. So first of all, let us find out the weights. In order to find out the weights, first of all, we will have to add the total book value of all the sources of the finance. So 2 lakhs plus 1,30,000 plus 1,70,000, it comes to 5 lakh. Okay, so it comes to 5 lakh. Now we have to find out the weight. In order to find out the weight, what we have to do is we have to take the book value of that respective source of finance and divide it with the total book value. So let us do that. 2 lakh divided by 5 lakh. Same way, 1,30,000 divided by 5 lakh. Similarly, 1,70,000 divided by 5. Now, what are the weights that we get over here? The first weight is 0.4. The second weight is 0.26. And the third weight is 0.34. So now you got the respective weights of all the different sources. For equity you got the weight, for reserves you got the weight, for debt you got the weight. Now let us see the cost of capital. Now the KE basically, this is K cost. It can be KE for equity, KR for reserves, and KD for debt. So for equity, the cost, that is K, is given as 10%. So it is 10%. For reserves also it is given as 10%. Usually in a problem, if the KR, that is cost of reserves, is not given, usually cost of reserves is considered as equal to the cost of equity. Okay, if it is not given to you all, then you can consider the cost of reserves, that is KR, you can consider it as equal to KE. Okay, whereas the cost of debt, it is 4%. Now they have asked us to find out the weighted average cost of capital. In order to find out the weighted average cost of capital, we have to do nothing but take the weights, multiply it with the respective cost, and we will get the weighted average cost of capital. That's why you can see on top of weighted average cost of capital, I have put A multiplied by B. That is A multiplied by B. This is A, this is B. A multiplied by B, you will get weighted average cost of capital. But let me show you how you get it formula wise. It is the same thing if you do it this way also or if you do it this way also. In the end, you will have to add your answer over here or you can add your answer over here. So weighted average cost of capital, in this case it will be equity, cost of equity multiplied by the weight of equity plus cost of reserves multiplied by the weight of reserves plus cost of debt multiplied by the weight of debt. Okay, so we know the cost of equity, it is 10%. So it is 0.10 because it is 10%. 10%. 10% in the sense 10 divided by 100. Okay, multiplied by weight of equity. We know the weight of equity is 0.4 plus cost of reserves. We know that it is 10%. So 0.10 multiplied by weight of reserves, which is nothing but 0.26 plus cost of debt, which is 4%. So it is going to be 0.04 multiplied by weight of debt, which is nothing but 0.34. So it is 0.34. So now once you solve this equation, you will get WACC, that is weighted average cost of capital, as 7.96%. Okay, so it is going to come to 7.96%. I hope this is very much clear to you all and you all can understand what I am trying to say to you all. Okay, now let us move on to the next problem. Okay, so now let us start with the next problem. In the next problem, I'll read out the problem for you all. The following figures are taken from the current balance. That is, they have given us that there are reserves of 6 lakhs. There are reserves of 6 lakhs. Then there is irredeemable debentures of 4 lakhs. And there is share funds of 16 lakhs. They have given us the different sources of finance. They have also mentioned that the ordinary dividend is of rupees 2 and they have mentioned that the growth rate of that dividend is 10%. Okay, then they have given the present value of equity, which is 27.5, and they have also mentioned the debentures, the current value of the debentures as 80 rupees. They have asked us to find out the K, and that is K is nothing but the cost of capital, and they have asked us to find out the weighted average cost of capital. So these are the things which they have asked us to find out. Okay, so and these are the details which they have given to us. These are the different sources of finance which they have provided us with. Okay, so to begin with, let us try and find out the K, that is cost of capital for equity, cost of capital for debentures, and cost of capital for reserves. I told you that it is going to be equal to the cost of equity in most of the cases. If it is not given to you all, we have to take it into consideration that cost of equity is equal to cost of reserves. Okay, so now let us start with finding out the cost. We'll first find out the cost of debt, that is KD. Okay, let us find out the cost of debt, that is KD. Okay, we know that KD, that is cost of debt. Usually, cost of debt is equal to what? They have given us basically over here the present value. Based on that, we will find out. They have given us the present value. They have also mentioned that it is 12% irredeemable debentures. So we know that it is 12% irredeemable debentures, and we also know that the present value or the current market price is 80 rupees. Okay, I have also told you one thing. If the face value is not given, in that case we have to take it as 100. So in this case, since the face value is not given, we will take it as 100. So it is interest divided by market price. Interest is nothing but face value, which is 100. We are taking the face value as 100 over here because I am repeating again, when the face value is not given, in that time for the sources of finance, if the face value is not given, we take it as 100 because we want to find out the interest, and basically interest amount is usually calculated on the face value. So if you don't have the face value, how are you going to calculate the interest? That is the reason why if it is not mentioned anywhere, we take it as 100. So interest is nothing but 100, that is face value, multiplied by how much percentage is other debentures. They have said that it is 12% irredeemable debentures. So we take it as 12%, 100 into 12%, divided by the market price. The market price of the debentures, that is the present value of the debentures, they have said that it is 80 rupees. So divided with 80. So it is going to be 12 divided by 80, which is nothing but 0.15. Okay. So for debentures we know that cost of debt is equal to 0.15. So this one we found out. Now let us move on to find out the cost of equity, that is KE. Okay. KE. Now they have given us the present value, that is good. They have given us the growth, they have given us the dividend. So it becomes obvious to us that it is a growth model, and if it is a growth model, you have to take into consideration the G. So the formula which will be used over here is nothing but D1 divided by the market price, which is nothing but the present value of the market price, which is given to us already, plus G. Now D1 we need to find out. For that we need to calculate D1 from the current dividend. This is D0, that is the current dividend. But we need to find the dividend at the end of the first year. So usually I told you what is D1. How you will calculate D1? I had told you D1 is equal to D0 1 plus G. If you remember, this was the formula for D1. So D0 is given to us as 2. 1 plus G is given to us as 10%. So 2 multiplied by 1.10, which is nothing but 2.2. So it is going to be 2.2. D1 is going to be 2.2. I hope the calculation is understood over here. D1 is equal to D0 1 plus G. So it is 2, since D0, that is the current dividend is 2, and we are trying to find out the dividend at the end of 1 year. So 2 multiplied by 1 plus G, which is 0.10. Solve it, you will get D1. Okay, so D1 is what? 2.2. The current market price is what? 27.5. So 27.5 plus G, that is the growth, is 10%. So it is 0.10. Solve this. Once you solve that, you will get that KE is equal to 0.18. So we know KE, it is equal to 0.18. So I told you KE is equal to KR. Therefore, KR is equal to 0.18. So we have the cost, we have the book value, we can find out the weights, and from the weights we can find out the weighted average cost of capital. So let us start with that. Okay, so we have the book value. Now we will find out the weights. Then we will multiply it with the cost, and then we will get the weighted average cost of capital. Now weights. For equity, it will be 16 lakhs divided by 20 lakhs. This is going to be 4 lakhs divided by 20 lakhs. This is going to be 6 lakhs divided by 20 lakhs. Okay. So once you get this particulars, once you divide it, we will get the details. So WE, that is weight of equity, it is going to be what? It is going to be 16 lakhs divided by 20 lakhs, 0.80. Okay, then moving on to debentures, it is going to be 4 lakhs divided by 20 lakhs, it is going to be 0.20. And for KR, it is going to be 6 lakhs divided by 20 lakhs, which is 0.30. Now moving on to K, we have found out the K. KE is equal to 0.18, so it is 0.18. Then KD is equal to 0.15, so it is 0.15. KE is equal to KR, that's why KR is also equal to 0.1. Now we have to find out the weighted average cost of capital, which is nothing but A multiplied by B. That is A multiplied by B. So 0.80 multiplied by 0.18, it comes to how much? That you will have to calculate and you will have to write it down over here. But I will use the formula because the formula for me is much better. You all can do it this way and then you can take the sum and you can get the weighted average cost of capital. But I'm not going to do that. I'm going to use the formula. Okay. So weighted average cost of capital is equal to WE multiplied by KE plus WR multiplied by KR plus WD multiplied by KB. Now WE is how much? Weight is 0.80. Weight of equity is how much? 0.80. Cost of equity is how much? 0.18. Plus reserves, weight of reserve is how much? 0.30, 0.30 multiplied by cost of reserves is how much? 0.18. Plus weight of debt is how much? It is 0.20 multiplied by cost of debt is how much? 0.15. So based on this, we will get the weighted average cost of capital, which is nothing but 0.228. So it is coming to 0.228, which is nothing but 22.8%, which is nothing but 23%. So with this, we got the weighted average cost of capital. That is weighted average cost of capital, we will get it as 23% over here. So this is the way with which you have to calculate. Firstly, we have to find out the cost. If the cost is not given, it is we have to find out the K. If the K is not given for all the sources of finance, and then we will have to find out the weights, multiply the cost with the weights in order to find the weighted average cost of capital. Okay. So that was the problem. We will solve more two problems like this, so that it becomes very easy for you all. You all also understand how to go about with it. Okay. So so let us move on to the next problem. I'll read out the problem for you all. The following information has been extracted from the balance sheet of Fashion Limited. So there is equity share capital, 12% debentures and 18% term loan. So they have specified exactly to us the different sources of finance, and also they have given us the book value of those finances. So they have asked us to determine the weighted average cost of capital of the company. It has been paying dividends consistently at the rate of 20% premium per annum. So they have asked us to find out the weighted average cost of capital. They have mentioned to us that they have been paying dividends consistently at 20% per annum. So dividend percentage is 20%. Okay. What difference will it make if the current price of rupees 100 per share is rupees 160? They have asked us to determine the effect of income tax on the cost of capital under both premises, and they have given us the tax rate as 40%. So tax is equal to 40%. So they have given us the tax, they have given us the dividend percentage, they have asked us to find out the weighted average cost of capital. Now, what are the details with respect to sources of finance? So let us write down. The first one is equity share. The second one is 12% debentures. So 12% debentures. And the third one is 18% term loan. So these are the details which are given to us. Now let us write down the book value. Okay. So for equity it is 400. For For 12% debentures, it is 400. For 18% term loan, it is 1,200. So the total it comes to around 2,000. Now this is in terms of lakhs, but let us write it down this way because they have given it that way. They have asked us to find out now. Obviously, we are supposed to find out the cost, that is K, and then we are supposed to find the weighted average cost of capital. Okay, so let us start first with determining the weight. Okay, so let us write down the weight. Okay, so it is going to be 400 divided by 2000. This is also going to be 400 divided by 2000. So it will be 1200 divided by 2000. So the first weight for WE is 0.20. This is 0.20. So WE is equal to 0.20. Then WD is going to be the same, that is equal to 0.20. And we have term loan, that is WL, which is going to be, since it is 1200, is going to be 0.60. So now we have got the weights, that is 1200 divided by 2000, we will get 0.60. 400 divided by 2000, we will get 0.20. 400 divided by 2000, we will get 0.20, because we are trying to basically find the weight. And how you will find the weight, how much weight does equity hold, how you will find it by taking the number of equity, that is 400, divided by the total capital. The total capital is 2000 lakhs, but equity is 400 lakhs. So that is the reason why we take 400 divided by 2000 to get the weight of equity in the total capital. So what this means basically is W is equal to 20. It means that 20% of the capital is equity. Again, what is the meaning of WD 0.20? It means that 20% of the capital is debentures. What does this WL is equal to 0.60 means? It means that the term loan accounts for 60% of the capital. Okay, so with this you can know that the maximum of the capital is raised by the company through term loans. Okay, so now we got the weights. Now let us try and find out the cost, because that is the important part. So now let us start with calculation of KE. Okay, so KE. Now they have given us the G, that is growth, which was 20%. They told us that the dividend is given at the rate of 20%. So basically it is growing at the rate of 20%. Then we can calculate the D1. We know the PO. We know the PO. I told you, when the face value is not given, we are supposed to assume that the face value is rupees 100. So basically the face value, that is nothing but the PO, is equal to what? It is equal to 100. We have given the growth rate, we can find out the D1, we know the face value, which is 100. So we know the face value, which is 100. We know that the growth rate is equal to 20%. We have to find the D1 first. So let us write down the formula first, which is D1 divided by present market value plus G. So we need to find out D1, for which we need D0, and then we are going to do 1 plus G. So now we know that the dividend is given at 20%. So obviously D0 is going to be nothing but 100, that is the face value, multiplied by the 20%. Multiply this with 1 plus G. So 20 G is nothing but 20 only. They said that the dividend is given at 20% and it is also growing at 20%. So that is the reason why we are doing this. The same thing that we did with respect to equity, finding the KE, that is cost of capital of equity. equity, what we had done? We had done the same thing. In order to find out the D1, that is dividend at the end of 1 year, we take the present dividend, that is D0, and multiply it with 1 plus G. So you get over here 24. So we know D1, we know the current market value, that is nothing but the face value, which is 100. I told you all, if the face value is not given for any source of finance, we are taking it as rupees 100. So we know the market value, we know the growth rate. Let us do it. So D1 is how much? D1 is 24. Market value, the face value, plus G, it is 20%. Solve this. After solving it, you will get KE as 0.44. Okay, which is nothing but 44%. So we found out KE. We'll write it down over here. KE is equal to 44%. So we know what is KE. Now let us move on to the next. Okay, we found out what is KE. Now let us move on to the next, that is KD. Now if you read the problem, in the second point, that is point B, it has said what if the current price is not 100? What if the current price is 160 in case of equity also? Then again we'll have to calculate A. For that we'll do later. First we'll do the first method with considering that the face value is rupees 100 only. That is considering that the present value is rupees 100 only. Let us solve this first. Then we can move on to the current value. If it is 160, what will be the situation? Okay. So KD. Okay, now let us try and find out KD. KD, you all know for that we are taking interest 1 minus tax divided by market present value. It is present value of market present value of that debenture. So now we know that it is 12% debentures. I have told you all that if the face value is not given to us, then in that case we have to take 100 as the face value. Okay. So let us solve this. Face value, we will take it as rupees 100. We know that the interest rate is 12%. Okay. We know that the tax rate is 40%. It is given in the question only. So, in that case, what will be KD? So, KD, it is going to be 100 into 12%. Since it is 12% debentures, 1 minus tax, which is 0.40, tax rate is 40%, divided by the current market price. Since in this case we are considering that the current market price is rupees 100, for that reason we are taking the market price as 100. So this is going to be 12, 1 minus 0.40, the whole divided by 100, which in that case it comes to 0.072. 0.072, which is nothing but 7.2%. So let us write down over here KD is equal to 7.2%. Okay. So we got the KD. Now let us move on to the next. Next source of finance we had was long-term debt. Now for that also we will have to follow the same procedure. Only thing is it is 18% term loan. I told you all debentures and debt is more or less the same thing. So we'll have to follow the same formula. So the formula will remain the same. Only thing is over here the interest rate will become 18% since it is an 18% term loan. Okay, so it will be 18% into 100 and this 1 minus tax, which is 0.40, the whole divided by current market value, which is rupees 100. So in that case it becomes 18, 1 minus 0.40 divided by 100, which in that case comes to 0.108, which is nothing but 10.8%, which is what we are going to write. So KD KL is equal to 10.8%. So we found out the cost, we have the rates. What are we waiting for? Let us calculate the weighted average cost of capital. Now this is the first scenario where the current price is rupees 100. Okay. Where the current price, which is nothing but PO is equal to 100. In that case, we are calculating the weighted average cost of capital, which is nothing but KE into WE plus KD into WD plus KL into WL. Okay. So, if it is not visible, I will write it again. So now we have to calculate the weighted average cost of capital, which is nothing but KE into WE plus KD into WD plus KL into WL. Okay. So KE, what is KE? 44%. So 44% is 0.44 multiplied by WE. What is the weight? WE is 0.20. 0.20 plus KD is how much? 7.2. So it is 0.072 into WD is how much? 0.20. So it is 0.20 plus KL is how much? 10.8%. 10.8% in the sense 10.8 divided by 100. That is the reason why we are writing it as 0.108 into WL. WL is how much? 0.60. So it is 0.60. So let us solve the equation, and after solving the equation you will get the weighted average cost of capital as 0.1672. 0.1672, which is nothing but 16.72, which is approximately equal to 17%. Okay, so this is the first scenario where the current price is rupees 100. But if you read the problem, what they have said? They have said that in the B point C, what difference will it make if the current price of rupees 100 per share is rupees 160? And they have asked us to find out the the weighted average cost of capital in the second scenario as well. So let us find out the weighted average cost of capital in the second scenario as well. In that case, the KE and all will change, but the weights will remain same because the weights are based on the book value. The book value has not changed. Only the current market price per share is changed, which is 100. For that purpose, we will have to change the entire calculation of cost, that is K. Okay. Where the current market price is rupees 160, in that case, now we are going to see what is going to be the cost of equity, cost of debt, and cost of loan. So first of all, let us find out the cost of equity, which is KE is equal to D1 market price plus G. Now D1 we will have to calculate again. Do we have to calculate D1 again? Yes. Why? Because the dividend has changed. So the percentage, dividend percentage was dividend The percentage was 20%. The 20% will remain same, but dividend at the end of 1 year is equal to current dividend 1 plus G. Now the current dividend, the previous one, we calculated on 100 rupees because we had considered that the share price is 100 rupees. But in this case, we are considering the share price is 160 rupees. So 160 into 20%, we will have to take 1 plus G. 160 into 20%, it is coming to how much? 32. 1 plus G is how much? 20. So 0.20, growth is 20. So after solving this equation, you will get that D1 is nothing but 38.4. Well understood why the D not is changing, because in the previous problem we took into consideration 100 rupees as the current market price or the current face value, and on that 100 rupees we took the dividend percentage of 20%. That's why our dividend D naught was 20 rupees in the first place. But currently we are considering that the current market price is 160. That is the reason why we will have to take 160 and multiply it with 20%. On that we get it as 32. The dividend, the current dividend we get as 32. Multiply it with 1 plus G, we are going to get D1. So this is D1 at the end of 1 year. That is dividend at the end of 1 year is 38.4. So we got that 38.4. Now current market price, that is MPO, we are saying that the current market price is 160. So we will take it as 160 plus G, it is 0.20. After solving this, you get KE as what? The same rate you get, that is 0.44. 0.44. So it is going to be 44% only in case of second case also. In case where the current market price is 160 rupees also, we are getting KE as 44. So it is well and good. Okay. Then let us solve further. Let us find out KD and let us find out KL. KD, it is going to be interest 1 minus tax, the whole divided by current market price. Now interest, it is going to remain same. Interest rate is going to remain same, that is 12%. But on the value which we are going to calculate, it is going to become 160. Previously, we had calculated on 100 rupees. So 160 into 12%. 1 minus tax, which is 0.40, divided by current market price, which is 160. So it comes to around okay, I'll write this also. This is 19.2. 1 minus 0.40, the whole divided by 160. It comes to around 0.072, which is nothing but 7.2%. So it is coming to around 7.2%. More or less it will come nearby only, it won't deviate that much, but we are supposed to use both the ways to find out the weighted average cost of capital. Then we are going to find out Kn. Kn also the formula remains the same. Okay, everything remains the same. Only thing is the percentage of Kn over here is specified as 18%. So we will have to take 18% for calculation of interest. So over here it will become 18%. The tax is the same, the current market price is the same. Only thing is the interest has changed in case of KL, that is the term loan. Okay, so it is going to be 28.8, 1 minus 0.20, the whole divided by 160. So it is coming to 10.8%. So this is 10.8%. If you see, it is coming more or less the same. Nothing much of a difference. Now let us calculate the weighted average cost of capital. So using the same way what we did previously, that is KE multiplied by WE plus KD multiplied by WD plus KL multiplied by WL. Okay, doing the same thing, do it. I won't solve this. I'll just tell you the final answer in this case. It is coming to around 16.72, which is the same as what we got for the previous one. The same unit, okay? Weighted average cost of capital will be the same. Excuse me if I am using working average cost of capital. It is weighted average cost of capital. It is just a slip of tongue. So it is weighted average cost of capital. So this is the problem. I hope it is clear. These problems, weighted average cost of capital problems are very important. They will come for your exam. Make sure, though they are very lengthy, make sure you all jot down whatever particulars are given and then solve the problem. Very easy, nothing difficult. So in the ninth problem, I'll read out the problem to you all. A financial analyst of a large electronics company, you are required to determine weighted average cost of capital of the company using the book value weights and the market value weights. The following information is available for your purpose. The company's present book value they have given. For preference shares it is 2 lakhs, for equity it is 10 lakhs, for debentures it is 8 lakhs. And then they have also mentioned the recent prices of debentures, preference shares and equity shares. Then, anticipated external financial opportunities are the first one, rupees 100 per debenture redeemable at par, 10-year maturity, 13% coupon rate, 4% flotation cost, sales price rupees 100. So they have mentioned over here that the coupon rate is 13% and the flotation cost is around 4%. Then the sales price also they have mentioned, which is 100. So let us write down the particulars first and let us find out the cost first and then we can find out the weights, because weights they have asked us to use the book value as well as the market value weights. So in two ways we have to find out the weighted average cost of capital. So let us find out first the K, that is the cost. Okay, so they have given us basically that the present value of the debenture is, it is the face value is 100 and it is par. So it is issued, so it is going to be redeemed at par. Okay. Then they have said that it has 10-year maturity, so they have given us N, which is 10. Then they have also mentioned the rates. So coupon rate is 13% and flotation cost, okay, flotation cost is equal to 4%. So the sales price is rupees 100 they are saying. So now let us try and find out the the KB in this case. It is debentures. So let us try and find out the KD in this case. Okay, let us write down the formula. Have they mentioned the tax rate over here? The tax rate is mentioned as 50%. So let us start. Okay. So KD is equal to interest 1 minus tax plus redemption value minus sales value divided by N, the whole divided by redemption value plus sales value divided by 2. So the interest, let us calculate on the face value, which is going to be 100 into 30%, which is going to be obviously 30, and 1 minus tax. Tax is 50%. So tax is equal to 50%. Okay, plus redemption value minus sale value. Now it is going to be redeemed at par with the same. But if you remember, there is flotation cost. So the flotation cost needs to be taken into consideration in order to understand the present value or the sales value. So the sales value or the present value, it is equal to 100 minus the flotation cost of 14%, which is nothing but it comes to around 96. So it comes to around 96. So you know the sales value or the present value, you know that it is going to be redeemed at par. So it is going to be 100, that is it is going to be redeemed at par, that is at the face value, minus the current price which is 96, divided by n which is nothing but number of years, it is given as 10. The whole divided by 100 plus 96 divided by 2. So it is going to come up to how much? So it is going to work out to 0.07, 0.07, which is nothing but 7 percentage. So we got KD, which is 7 percentage. So the first cost done. Now let us move on to the second cost. Okay. Rupees 100 preference share redeemable at par, 10-year maturity, 14% dividend rate, 5% flotation cost. So everything is mentioned over here basically. So let us rub this and write down the particulars for preference shares. So preference shares we are not taking into consideration the tax. I hope you all know why it is. If you all don't know, please refer to the explanation. Okay, I have given proper explanation in my previous videos. Okay, so for preference shares, it is redeemable after 10 years, so n is equal to 10, and its dividend rate, okay, so its interest is 14% and flotation cost is 5%. So these are the difference which they have specified over here. The sale price is rupees 100 they have said. So using the formula, let us solve the problem. So KP is equal to dividend plus redemption value minus sales value divided by N. The whole divided by redemption value plus sales value divided by 2. So dividend, we are going to calculate it on the face value which is rupees 100. So it is going to be 100 into 14% plus redemption value, we know that it is going to be redeemed at this 100 only, minus we want the sales value. Now the sales value or the present value, it is going to be 100 minus the flotation cost. Now 100 minus 5%, since flotation cost in case of preference shares is 5%. So it is going to come to 95. So your sales value or your present value is 95 divided by N, which is 10, the whole divided by 100 plus 96 divided by 2. Solving the equation, we get Kp as 14.87. So it comes to 14.87%. So we got the cost of preference shares. Let us write down Kp is equal to 14.87. Okay. Now let us move on to finding the next. Now let us move on to equity. We are finished with KP. Now let us move on to equity. I'll read out what they have mentioned in case of equity. Equity shares rupees 2 per share floating cost. So floating cost is rupees 2 per share and the sales price is rupees 22. Then they have said in addition, the dividend expected on the equity share at the end of the year is rupees 2 and the earnings are expected to increase at 7% per annum. So you know the sales price, you know the flotation cost, you also know the dividend and you also know the growth rate in case of equity. Okay. And then the last I have mentioned the corporate tax which is 50%, which I have already told you all that they have mentioned that it is 50% tax. So now let us calculate KE. Same price in case of equity they have said it is 22. Dividend they have said that it is 2. Growth rate they have said it is 7%. And the flotation cost they have said it is 2 per share. So these are the details which are mentioned. So let us find out the KE. KE is equal to D1 divided by the market price plus G. Now, we know that, so now this is the formula that we are going to use. Now if you see over here, look at the problem. They have said that the dividend expected on the equity share at the end of the year is 2. So they have given us dividend at the end of 1 year. So D1 is given as 2. So we don't have to calculate D1 in that case. We can directly substitute D, that is D1 is equal to 2. We know the growth rate, which is 0.07. Now the market price per share. They have given us the flotation cost. So we have to minus the flotation cost from the current market price. Okay. So we are going to get the current market price, which is equal to 22. The current market price is given as 22 minus the flotation cost. So 22 minus the flotation cost. The flotation cost is rupees 2. So it is going to come to 20. So you have to divide 2 divided by 20, and now you have to solve this problem. So 2 divided by 20 plus 0.07, you get the answer as 0.17. Okay, so it is coming to around 17%. So KE is equal to 17%. Okay, so this is the way with which you are supposed to find out the cost. Now you found out the cost in all the three cases. So now let us find out the weighted average cost of capital. Okay, so we have the first case of finance, which is preference shares. Then we have the equity shares. And then we have the debentures, right? And the book value, it is given to us as follows. So for preference shares, it is 2 lakhs. For equity, it is 10 lakhs. And for debt, it is debentures, it is 8 lakhs. So you add all these three and you get it as 20 lakhs. Okay, so now we can calculate the weights. Calculate the weights. So it will be 2 lakhs divided by 20 lakh, then 10 lakh divided by 20 lakh, 8 lakh divided by 20 lakh. Okay, so based on this, you get the weights, which is 0.10, this is 0.50, and this is 0.40. Now you know the cost, you know the weights, we can find the weighted average cost of capital, which is nothing but KP into WP plus KE into WE plus KD into WD. KP is how much? 14.87. So 0.1487 multiplied by WP. WP is how much? Weight is how much? Weight is how much? 10. So it is 0.10 plus KE is how much? 17%. So it is 0.17 multiplied by WE, which is nothing but 0.50 plus KD, which is equal to 7%, 0.07 multiplied by WD, which is 0.40. So after solving this, you will get the answer as 12.78%. So 12.78%, which is equal to approximately equal to 30%. So now this you all did using the book value. This was the first way that they had asked us to find out. Now let us do it using the market value weights. Okay.